Hi everyone, I'm Lorenzo Di Mattia, manager of Hedge Invest Sibilla Macro Fund. Wanted to tell you what we have done in January and give you the outlook for the rest of the year. January was a basically break-even month. We started the month pretty well. We've been long reopening trades and cyclicals with the belief that it's basically the only area where there is still significant upside this year. Due to the fact that we are right now still in full lockdown in most of the developed world, ex-China, and we believe that by mid-year, finally, the economy will reopen, and so traveling will pick up significantly. And a lot of traveling company, aerospace, hotels, basically most of the hospitality industry will enjoy profits even higher than 2019 because the competition has been declining. A lot of companies unfortunately went out of business, from hotels, boutique hotels, restaurants, and so on. And we believe the earning power of many of these companies, the survivors in the hospitality industry, have significant upside. So we held positions in this theme, in this sector, and we were hedging by shorting Nasdaq and the S&P. There is a lot of speculation and extremely high valuations elsewhere in the market, especially in the alternative energy sector, in software, technology, semiconductors, and most of the market really except for cyclical and reopening and hospitality sector. So we've been hedging with these positions, and in the second half of the month, a very unusual dislocation started in the market. Short covering of unprecedented proportions happened in several stocks, the most famous of which is GameStop, which actually pushed several hedge funds down double digit in January. And the consequence of this dislocation was that not only did they have to cover shorts, which were completely asymmetric all of a sudden, giving almost unlimited downside and limited upside. So there's been a run in short covering, really historical short squeeze. But this led to also selling longs in positions that make sense still, including reopening. So we actually saw this coming pretty early in the month and started to cut. We cut the book by about 2/3, and this helped actually limiting the drawdown on our long positions, but it allowed us to hold most of them and re-increase toward the end of the month. So pretty happy about risk management this month. Obviously, it would have been better if it were positive, but given the dislocation, it's been decent. Going forward, we remain with the same idea. There are many areas of the market extremely speculative. We are trying to short them, definitely not be long these areas. We don't want to short single stocks too much. It's very risky, especially in a bubble of this scale. But we do like to hedge with things that are really overvalued and with obviously stop losses, but have significant downside and limited upside. But we still want to maintain long positions in hospitality and reopening and cyclicals. And rates will move up over the course of the year, and the dollar is probably stable or even rallying. And we have an inflation issue at some point in the future. This will put significant pressure on growth, probably alternative energy sector, and eventually the whole market. We expect corrections of 5, 10, maybe even 15% from here until mid-year, possibly the fall, and then a severe bear market will start probably from higher. We are estimating that the S&P might reach 4,000, even 4,500, given the scale of this liquidity bubble, the stimulus, and the reopening trade also functioning in the second quarter and the third quarter. And so the real bear might start from higher, but we will start to see volatility and corrections, especially in the speculative areas. And we plan to exploit in the first half of the year both the long and the short side in these different themes. And then the second half of the year will be, in our opinion, ironically, just when the economy gets back to normal, will start a probably pretty significant bear market. Thank you very much.